Chapter 3, The DOW Theory. The DOW theory is the granddaddy of all technical market studies, although it is frequently criticized for being too late and occasionally derided, particularly in the early stages of a bear market, by those who rebel at accepting its verdicts. It is known by name to nearly everyone who has had any association with the stock market and respected by most. Many who heed it in greater or lesser degree in determining their investment policies never realize that it is purely and simply technical. It is built upon and concerned with nothing but the action of the stock market itself, as expressed in certain averages, deriving nothing from the business statistics on which the fundamentalists depend. There is much in the writing of its original promulgator, Charles H. Dow, to suggest that he did not think of his theory as a device for forecasting the stock market or even as a guide for investors, but rather as a barometer of general business trends. Dow founded the Dow Jones Financial News Service and is credited with the invention of stock market averages. The basic principles of the theory, which was later named after him, were outlined by him in editorials he wrote for the Wall Street Journal. Upon his death in 1902, his successor as editor of the journal, William P. Hamilton, took up Dow's principles and, in the course of 27 years of writing on the stock market, organized them and formulated them into the Dow theory as we know it today. Before we proceed to an explanation of the theory itself, it will be necessary to examine the stock averages which it employs. Long before the time of Dow, the fact was familiar to bankers and businessmen that the securities of most established companies tended to go up or down in price together. Exceptions, stocks that moved against the general financial tide, were rare, nor did they, as a rule, persevere in the contrary course for more than few days or weeks in time. It is true that when a boom was on, the prices of some issues rose faster and farther than others, and when the trend was toward depression, some stocks declined rapidly while others would put up considerable resistance to the forces that were dragging the market down. But the fact remained that the most securities tended to swing together. They still do, needless to say, and always will. This fact, as we have said, has long been commonly known and accepted, so completely taken for granted that its importance is usually overlooked. For it is important, tremendously important for many angles, in addition to those which come within the province of this volume. One of the best of all reasons for a student of market techniques to start with the Dow theory is because the theory stresses the general market trend. Charles Dow is believed to have been the first to make a thorough effort to express the general trend, or more correctly, level, of the securities market in terms of average price of a selected few representative stocks, as finally set up in the January of 1897, in the form of which has been continued to date and used by Dow in his studies of market trends. There were two Dow Jones averages. One was composed of 20 railroad companies only, for the railroads were the dominant corporate enterprises of his day. The other, called the industrial average, represented all the other types of business and was made up at first of only 12 issues. This number was increased to 20 in 1916 and 30 on October 1, 1928. The Dow averages. The stocks included in these two averages have been changed from time to time in order to keep the lists up to date and as nearly representative as possible of their respective groups. Only General Electric of the present 30 industrial stocks was included in the original industrial average, and that was dropped at one time in 1899 and subsequently reinserted. In 1929, all stocks of public utility companies were dropped from industrial average and new utility average of 20 issues was set up. In 1938, its number was reduced to 15. The 20 rail, 30 industrial, and 15 utility stocks are now averaged together to make what is known as the Dow Jones Stock Composite. The history of these averages, the various adjustments that have been made in them, and their method of computation is an interesting story in itself which the reader may want to look up elsewhere. For our present purpose, it remains only to add that the Dow theory pays no attention to the utility or composite averages. Its interpretations are based on the rail and industrial averages only. In the recent years, the values of the Dow Jones averages have been computed for the end of each hour of trading as well as the end of the day. The Wall Street Journal also prints in each issue a summary of important highs and lows of each average by date of for the preceding 2 or 3 years. Their daily closing prices are reported in many other metropolitan daily newspapers. The basic tenets. To get back to the Dow theory itself, here are its basic tenets. Number 1. The averages discount everything except acts of God. Because they reflect the combined market activities of thousands of investors, including those possessed of greatest foresight and best information on trends and events, the averages in their day-to-day fluctuations discount everything known, everything foreseeable, every condition which can affect the supply of or demand for corporate securities. Even unpredictable natural calamities which they happen are quickly appraised and their possible effects discounted. Number 2, the 3 trends. The market, meaning the price of stocks in general, swing in trends, of which the most important are its major or primary trends. These are the extensive up and down movements which are usually last for a year or more and result in general appreciation or depreciation in value of more than 20%. Movements in the direction of primary trend are interrupted at intervals by secondary swings in the opposite direction, reactions or corrections that occur when the primary move has temporarily gotten ahead of itself. Both secondaries and intervening segments of the primary trend are frequently lumped together as intermediate movements, a term which we shall find useful in subsequent discussions. Finally, the secondary trends are composed of minor trends or day-to-day fluctuations which are unimportant to Dow theory. Number 3, the primary trends. These, as aforesaid, are the broad, overall up and down movements which usually, but not invariably, last for more than a year and may run for several years. So long as each successive rally, price advance, reaches a higher level than one before it, and each secondary reaction stops, that is, the price trend reverses from down to up at a higher level than the previous reaction, the primary trend is up. This is called a bull market. Conversely, when each intermediate decline carries price to successively lower levels and each intervening rally fails to bring them back up to the top level of preceding rally, the primary trend is down, and this is called the bear market. The terms bull and bear are frequently used loosely with reference, respectively, to any sort of up and down movements, but we shall use them in this book only in connection with the major or primary movements of the market in the Dow sense. Ordinarily, theoretically at least, the primary is only one of the 3 trends with which the true long-term investor is concerned. His aim is to buy stocks as early as possible in the bull market, just as soon as he can be sure that one has started, and then hold them until and only until it becomes evident that it has ended and a bear market has started. He knows that he can safely disregard all the intervening secondary reactions and minor fluctuations. The trader, however, may well concern himself also with the secondary swings, and it will appear later in this book that he can do so with profit. Chapter 4, the secondary trends. These are the important reactions that interrupt the progress of prices in the primary direction. They are the intermediate declines or corrections which occur during the bull markets and the intermediate rallies or recoveries which occur in the bear markets. Normally, they last for 3 weeks to many months and rarely longer. Normally, they retrace from 1/3 to 2/3 of gain or loss, as the case may be, in prices registered in the preceding swing in the primary direction. Thus, in a bull market, prices in terms of industrial average might rise steadily and with only brief and minor interruptions for a total gain of 30 or 300 points before a secondary correction occurred. That correction might then be expected to produce a decline of not less than 10 points, not more than 20 points before a new intermediate advance in the primary bull trend developed. Note, however, that the third, 1/3, 2/3 rules is not an unbreakable law. It is simply a statement of probabilities. Most secondaries are confined within these limits. Many of them stop very close to the halfway mark, retracing 50% of preceding primary swings. They seldom run less than 1/3, but some of them cancel nearly all of it. Thus, we have 2 criteria by which to recognize the secondary trend. Any price movement, contrary in direction to the primary trend that lasts for at least 3 weeks and retraces at least 1/3 of the preceding net move in the primary direction from the end of the preceding secondary to the beginning of this one, disregarding the minor fluctuations, is labeled as intermediate rank, that is, a true secondary. Despite these criteria, however, the secondary trend is often confusing. Its recognition, its correct appraisal at the time it develops, and while it is in process, poses the Dow theory's most difficult problem. We shall have more to say about this later. The minor trends. Number 5, the minor trends. These are the brief, rarely as long as 3 weeks, usually less than 6 weeks, fluctuations which are, so far as the Dow theory is concerned, meaningless in themselves, but which, in toto, make up the intermediate trends. Usually, but not always, as intermediate swing, whether a secondary or segment of a primary between successive secondaries is made up of a series of 3 or 4 distinguishable minor waves. Inferences drawn from these day-to-day fluctuations are quite apt to be misleading. The minor trend is the only one of the three trends which can be manipulated, although it is in fact doubtful if under present conditions even that can be purposefully manipulated to any important extent. Primary and secondary trends cannot be manipulated. It would strain the resources of the US Treasury to do so. Right here, before we go on to state the sixth DOW tenet, we may well take time for a few minutes to clarify the concept of the three trends by drawing an analogy between the movements of the stock market and the movements of the sea. The major trend in stock prices are like the tides. We can compare a bull market to an incoming or flood tide which carries the water farther and farther up the beach until finally it reaches the high water mark and begins to turn. Then follows the receding or ebb tide comparable to a bear market, but all the time during the both ebb and flow of the tide the waves are rolling in, breaking on the beach and then receding. While the tide is rising, each succeeding wave pushes a little farther up onto the shore, and as it recedes does not carry water quite so far back as did its predecessor. During the tidal ebb, each advancing wave falls a little short of the mark set by one before it, and each receding wave uncovers a little more of the beach. These waves are intermediate trends, primary or secondary, depending on whether the movement is with or against the direction of the tide. Meanwhile, the surface of the water is constantly agitated by wavelets and ripples and cat's paws, moving with or against across the trends of the waves. These are analogous to the market's minor trends. It seems unimportant day-to-day fluctuations. The tide, the wave, and the ripple represent respectively the primary or major, the secondary or intermediate, and the minor trend of the market. Tide, wave, and ripple. A shore dweller who had no tide table might set about determining the direction of the tide by driving a stake in the beach at the highest point reached by an incoming wave. Then if the next wave pushed the water up beyond his stake, he would know that tide was rising. If he shifted his stake with a peak mark of each wave, a time would come when one wave would stop and start to recede short of his previous mark. Then he would know that the tide had started to ebb. That, in effect, and much simplified, is what the DOW theory does in defining the trend of the stock market. The comparison with the tide, wave, and ripple has been used since the earliest days of the DOW theory. It is even possible that the movements of the sea may have suggested the elements of the theory to DOW. But analogy cannot be pushed too far. The tides and waves of the stock market are nothing like as regular as those of the ocean. Tables can be prepared years in advance to predict accurately the time of every ebb and flow of the waters, but no timetables are provided by the DOW theory for the stock market. We may return to some points for this comparison later, but we must proceed now to take up the remaining tenets and rules of the theory. Major trend phases. The bull market, number 6. Primary uptrends are usually, but not invariably, divisible into 3 phases. The first is the phase of accumulation, during which far-sighted investors, sensing that business, although now depressed, is due to turn up, are willing to pick up all the shares offered by discouraged and distressed sellers and to raise their bids gradually as such selling diminishes in volume. Financial reports are still bad, in fact often at their worst during this phase. The public is completely disgusted with the stock market, out of it entirely. Activity is only moderate but beginning to increase on the rallies, minor advances. The second phase is one of fairly steady advance and increasing activity as improved tone of business and a rising trade in corporate earnings begin to attract attention. It is during this phase that the technical trader normally is able to reap his best harvest of profits. Finally comes the third phase, when the market boils with activity as the public flocks to the boardrooms. All the financial news is good, price advances are spectacular and frequently make the front page of the daily newspapers, and new issues are brought out in increasing numbers. It is during this phase that one of your friends will call up and blithely remark, "Say, I see the market is going up, what's a good buy?" All oblivious to the fact that it has been going up for perhaps 2 years, has already gone up for a long ways, and is now reaching the stage where it might be more appropriate to ask, what's a good thing to sell? In the last stage of this phase, with speculation rampant and volume continues to rise, but air pockets appear with increasing frequency, the cats and dogs, low price stocks of no investment value, are wheeled up, but more and more of the top grade issues refuse to follow. The bear market. Primary downtrends are also usually, but again not invariably, characterized by 3 phases. The first is the distribution period, which really starts in the later stages of the preceding bull market. During this phase, far-sighted investors sense the fact that business earnings have reached an abnormal height and unload their holdings at an increasing pace. Trading volume is still high though, tending to diminish on rallies, and the public is still active but beginning to show signs of frustration as hoped for profits fade away. The second phase is the panic phase. Buyers begin to thin out and sellers become more urgent, and the downward trend of prices suddenly accelerates into an almost vertical drop while volume mounts to climactic proportions. After the panic phase, which usually runs too far relative to then existing business conditions, there may be a fairly long secondary recovery or sideways movement, and then the third phase begins. This is characterized by discouraged selling on the part of those investors who held on through the panic or perhaps bought during it because stocks looked cheap in comparison with prices which had ruled few months earlier. The business news now begins to deteriorate. As the third phase proceeds, the downward movement is less rapid but is maintained by more and more distressed selling from those who have to raise cash for other needs. The cats and dogs may lose practically all their previous bull advance in the first two phases. Better grade stocks decline more gradually because their owners cling to them to the last. And final stage of a bear market, in consequence, is frequently concentrated in such issues. The bear market ends when everything in the way of possible bad news, the worst to be expected, has been discounted, and it is usually over before all the bad news is out. The three bear market phases described in the preceding paragraph are not the same as those named by others who have discussed this subject, but the writers of this story truly feel that they represent a more accurate and realistic division of the primary down moves of the past 30 years. The reader should be warned, however, that no two bear markets are exactly alike, and neither are any two bull markets. Some may lack one or another of these three typical phases. A few major advances have passed from the first to the third stage with only a very brief and rapid intervening markup. A few short bear markets have developed no marked panic phase, and others have ended with it as in April 1939. No time limits can be set for any phase. The third stage of the bull market, for example, the phase of excited speculation and great public activity, may last for more than a year and run out in a month or two. The panic phase of a bear market is usually exhausted in a very few weeks, if not in days, but in 1929 through 1932, decline was interspersed with at least 5 panic waves of major proportions. Nevertheless, the typical characteristics of primary trends are well worth keeping in mind. If you know the symptoms which are normally accompany the last stage of a bull market, for example, you are less likely to be deluded by its exciting atmosphere. Principle of confirmation. Number 8. The two averages must conform. This is the most often questioned and most difficult to rationalize of all DOW principles. Yet it has stood the test of time. The fact that it has worked is not disputed by any who have carefully examined the records. Those who have disregarded it in practice have, more often than not, had occasion to regret their apostasy. What it means is that no valid signal of a change in trend can be produced by the action of one average alone. However, the chances remain that the industrialists will not be able to continue their upward course alone, that they will ultimately be dragged down again by the rails. At best, the direction of the primary trend is still in doubt. The above illustrates only one of many ways in which the principle of confirmation applies. Note also that at sea, it might have been said that the industrials had thus far not confirmed the rails in continuing the downtrend, but this had to do only with the continuation or reaffirmation of an existing trend. It is not necessary that the two averages confirm on the same day. Frequently, both will move into the new high ground together. But there are plenty of cases in which one or other lags behind for days, weeks, or even a month or two. One must be patient in these doubtful cases and wait until the market declares itself in a definite fashion. Number 9, volume goes with the trend. Those words, which you may often hear spoken with ritual solemnity but little understanding, are the colloquial expression for the general truth that trading activity tends to expand as prices move in the direction of the prevailing primary trend. Thus, in a bull market, volume increases when the price dwindles as prices decline. In the bear market, turnover increases when the prices drop and dries up as they recover. To a lesser degree, this holds for secondary trends also, especially in the early stages of an extended secondary recovery within a bear market, when activity may show a tendency to pick up on the minor rallies and diminish on the minor setbacks. But to this rule, again, there are exceptions, and useful conclusions can seldom be drawn from the volume manifestations of a few days, much less a single trading session. It is only the overall and relative volume trend over a period of time that may produce many helpful indications. Moreover, in Dow theory, conclusive signals as to market trends are produced in the final analysis only by price movement. Volume simply affords collateral evidence which may aid interpretation of otherwise doubtful situations. We shall have much more to say in later chapters about volume in specific relation to other technical phenomena. 10. Lines may substitute for secondaries. A line in Dow theory parlance is a sideways movement as it appears on the charts in one or both of the averages, which lasts for 2 or 3 weeks or so, sometimes for many months, in the course of which price fluctuates within a range of approximately 5% or less of their mean figure. The formation of a line signifies that pressure of buying and selling is more or less in balance. Eventually, of course, either the offerings within that price range are exhausted, and those who want to buy stocks have to raise their bids to induce owners to sell, or else those who are eager to sell at the line price range find the buyers have vanished and that in consequence they must cut their prices in order to dispose of their shares. Hence, an advance in prices through the upper limits of an established line is a bullish signal, and conversely, a breakdown through its lower limits is a bearish signal. Generally speaking, the longer the line in duration and the narrower or more compact its price range, the greater the significance of its ultimate breakout. Lines occur often to make their recognition essential to followers of Dow's principles. They may develop at important tops or bottoms, signaling periods of distribution or of accumulation respectively, but they come more frequently as interludes of rest or consolidation in the progress of established major trends. Under those circumstances, they take the place of normal secondary waves. A line may develop in one average while the other is going through a typical secondary reaction. It is worth noting that a price movement after a line, either up or down, is usually followed by a more extensive additional move in the same direction that can be counted on to follow the signal produced when a new wave pushes beyond the limits set by the preceding primary wave. The direction in which prices will break out of a line cannot be determined in advance of the actual movement. The 5% limit ordinarily assigned to a line is arbitrarily based on experience. There have been a few slightly wider sideways movements which, by virtue of their compactness and well-defined boundaries, could be construed as true lines. Further on in this book, we shall see the Dow line is in many respects similar to the more strictly defined patterns known as rectangles which appear on the charts of individual stocks. Number 11. Only closing prices used. The Dow theory pays no attention to any extreme highs or lows which may be registered during a day before the market closes, but takes into account only the closing figures, that is, the average of the day's final sale prices for the component issues. We have discussed the psychological importance of the end-of-day prices under the subject of chart construction and need not deal with it further here, except to say that this is another Dow rule which has stood the test of time. It works thus. Suppose an intermediate advance in a primary uptrend reaches its peak on a certain day at 11 a.m., at which hour the industrial average figures at say 152.45 and then falls back to close to 150.7. All that the next advance will have to do in order to indicate that the primary trend is still up is register a daily close above 150.70. The previous intraday high of 152.45 does not count. Conversely, using the same figures for our first advance, if the next upswing carries prices in an intraday high at say 152.6 but fails to register a closing price above 150.7, the continuation of the primary bull trend is still in doubt. In recent years, differences of opinion have arisen among market students as to the extent to which an average should push beyond a previous limit, top or bottom figure, in order to signal or confirm or reaffirm, as the case may be, a market trend. Dow and Hamilton evidently regarded any penetration, even as little as 0.01, in closing price as a valid signal. But some modern commentators have required penetration by a full 1.00. We think that the original view has the best of the argument, that the record shows little or nothing in practical results to favor any of the proposed modifications. One incident in June of 1946, to which we shall refer in the following chapter, shows a decided advantage for the orthodox any penetration whatsoever rule. 12. A trend should be assumed to continue in effect until such time as its reversal has been definitely signaled. This DOW theory tenet is one which, perhaps more than any other, has evoked criticism. Yet, when correctly understood, it, like all the others we have enumerated, it stands up under practical tests. What it states is really a probability. It is a warning against changing one's market position too soon, against jumping the gun. It does not imply that one should delay action by one unnecessary minute once a signal of change in trend has appeared, but it expresses the experience that the odds are in favor of the man who waits until he is sure, and against the other fellow who buys or sells prematurely. These odds cannot be stated in mathematical language as 2:1 or 3:1. As a matter of fact, they are constantly changing. Bull markets do not climb forever, and bear markets always reach a bottom sooner or later. When a primary trend is first definitely signaled by the action of the two averages, the odds that it will be continued, despite any near-term reactions or interruptions, are at their greatest. But as this primary trend carries on, the odds in favor of its further extension grow smaller. Thus, each successive reaffirmation of bull market, new intermediate high in one average confirmed by a new intermediate high in other, carries relatively less weight. The incentive to buy, the prospect of selling new purchases at a profit, is smaller after a bull market has been in existence for several months than it was when primary uptrend was first recognized. But this 12th DOW tenet says, hold your position pending contrary orders. A corollary to this tenet, which is not so contradictory as it may seem first, is a reversal in trend can occur at any time after the trend has been confirmed. This can be taken simply as a warning that the DOW theory investor must watch the market constantly if he has any commitment in it.